This is Money Talk Radio, and I'm Ellis Martin. Join me now for a conversation with Ken Konkin, the president and CEO of Tudor Gold. Tudor Gold trades on the TSX Venture Exchange as TUD, and in the U.S. on the OTC as TDRRF. The company's Goldstorm project in British Columbia, Canada's Golden Triangle, represents one of the largest gold discoveries in the past 30 years. Tutor has identified a staggering mineral resource of 27.9 million ounces of gold equivalent, 2.87 billion pounds of copper, and 128 million ounces of silver. The 17,918 hectare Treaty Creek property, in which Tudor Gold holds a 60% interest, borders the KSM property to the southwest and the Brucejack mine to the south. The past producing SK Creek mine lies 12 kilometers to the west. Mr. Konkin has over 35 years of geological experience throughout North and South America, as well as Russia. Ken Konkin worked for Silver Standard for 19 years and managed advanced exploration programs in Argentina, Peru, as well as the Golden Triangle in British Columbia, Canada. Ken, welcome to the program. Nice to visit with you again today.
Yeah, great to see you again, Alice. This is a long time coming.
I don't even know what to say. I'm looking at your latest news release and I'm having to clean my glasses to make sure I'm seeing things correctly. I don't even know what it means. You're going to have to walk us through it. 88.1% copper, 63.8% gold, 51.3% silver, flotation recoveries at Treaty Creek at the Goldstorm project. What does this mean?
Pretty straightforward. The nomenclature we use in extracting and milling for our metal, as we predicted, and we've been talking about it for a long time, because visually you can see that the lower portion of the CS600 has a very large copper component to it. And the big surprise is typically you get around 65 to 70% recoveries in copper with flotations. It's simply gravity, and flotation cells, basically by density, will separate your metals. And this one in particular is very rich. It comes out at 88%, which is about almost 10% higher than we expected. Better news than ever, but the reality is with the flotation, it will take some of the gold. So it pulls over 50% of the gold. So 63 point whatever percent gold goes with it. Silver is like the third metal. They tweak the recipe on the density of the fluids for the cleaners, they call them, to float the final cons. But what this does represent is a nice, simple, very economical way of extracting a saleable concentrate that is termed a very clean concentrate. What this will be is a dogfight for the purchasers to get this, because there are very few clean ores this clean. So what winds up happening is the purchasing agents for the concentrate, when they take it to their smelter, will mix a bunch of other elements that are deleterious, like some arsenic, some antimony maybe, because it'll be diluted by this great clean copper, gold, silver con to get basically under their emission standards. Will be able to take on other clients, concentrate with this. So they'll be really fighting for it, because they really need a clean material to go through. And this is what this is. So no deleterious metals and lots of it.
29% copper with significant gold and silver grades of 33 grams per ton. Gold, that's over an ounce of gold per ton. And then 96 grams per ton of silver. This is an outrageously amazing story in Canada.
At 29% copper is a very high grade. That's almost all pure chalcopyrite. So that's a very pure number. I was in a discussion with the metallurgist. He says it's almost impossible to get that high. It goes up to 33.4% as the maximum pure chalcopyrite. But the reason why the numbers are so high in the lower CS600 are because of the mineralogical change. It grades down from a pyrite chalcopyrite concentrate with some sulfur salts, tetrahedrite, tenonite. Those are just typical sulfur salts. But what it does, it introduces bornite, and bornite is a very high-grade copper sulfide that it comes with, and that's the queen of all of the metallurgical darling flotation minerals. So this is what we've got, is a very coarse grain, which, by the way, a lot of people don't understand this. If you were to take the same material and give it a bottle roll test, a simple thing a bottle roll test is to test for how much free gold's in the system. This has a very high recovery on that, with gold only. So it's well over 80%, 82.1%, I believe. It does have a very good leachability to it. So when you sell 65%, that rest of the 35% that goes through your tailings and the way of rougher tailings and the cleaners, those can also be recovered recovered. So we can keep tweaking this to get it up over 90%. There's no problem with us going forward with the metallurgy on any of the studies now. We see that we have a clear path to a very low capex project by way of hunting for the supercells, these high-grade hydrothermal structurally controlled breccias that are stacked up right through the heart of the lower CS600. And I really do beg everybody who's listening to go to our website to look at those 4 stacked supercells right where they need to be for the development of the lower CS600. So in short, we have a mine within a mine, a high-grade gold complex, and is developing within the middle of the biggest, richest part of our deposit in the copper domain that can produce up to 3 billion pounds of copper. It is really a beast. It's a geological marvel, but now we're seeing it to be a metallurgical darling. So when you compare it to other projects, it has, by way of a smaller capex, by way of a simple gravity flotation system, you'll get well over 75% of metal value out. You're well up in the probably 85% metal category now with just having said this. Running forward with some other tweaking metallurgically, you can keep on going and extract more, but the heavy lifting is over on the metallurgy aspect of this. Now it's more the direction of how you do it. So the meetings now just currently taking place is with a group of engineers, mining engineers, how you take on the permitting, how you attack the extraction of the ore body is what we're after now.
And the website again, audience, is Tudor-Gold.com. Ken, how many steps are we removing with this type of great building a mine and going into production?
This is a big one because what this does is it validates the fact that we do have a very clean looking, straightforward approach. In the past, people were saying that this has got all kinds of metallurgical issues. It does not. The majority of this, you can mine this thing for at 40,000 tons a day. You can produce over 17 years of production at 40,000 tons a day. Run this thing for just the lower CS600 and first taking out the high grade to help be a catalyst for the payment of the development for the CS600. So what this really does is it really reduces the risk by drawing down that initial capex. You do it in stages. For example, you may be able to build a 2,200 ton per day high grade plant just to go after the gold that's in these 4 stacked supercells, extract that for 7, 8, 9, 10 years. I'd say pick a number like 250,000 ounces a year, have that pay for the way for all the infrastructure required for the building out of the bigger mine when you get there in 7 years, say. So you've actually accumulated the time to not only get down deep enough to actually light up this thing with a block cave, but moreover, you'll have a really good understanding of all the geometry because you'll have access to drill stations, you'll have access to a 10,000 ton test. So this is now the vocabulary we'll be using, is taking these approaches to actually really define and refine how that process works. We did this at Brucejack. I remember everybody talking about how brutal this thing was going to be metallurgically, how horrible our grade estimate methods were, how this is not going to work. People even said there was no gold there. We just simply did a 10,000 and we expected to get a minimum of 4,000 ounces. We got 5,400 ounces. We were 40% undercutting our own estimates with that procedure. And people still said, no, there's no gold there. To this day, there's people who think that that thing was a myth. So it's just amazing what's out in the public sector, how people think of mines, how they were being manipulated or telling people that this is not a great project. This is a great project based on the grades, based on the metallurgy, the phenomenal recoveries we got, especially in the copper sector. Really shocked me.
So are we getting a free gold resource with copper? Or are we getting a free copper resource with gold? Which part of this is a bonus?
It's all mellow yellow, my friend. It's all yellow. Yellow metals, yellow jacket, call it whatever you want. You're selling something with excellent gold and silver credit. You know what? Pretty soon we're going to probably look at just looking at NSR, just look at what the total dollar value is, especially now with gold and copper busting out, silver too. So if you just convert it to a dollar value, it's about making money, honey. That's what we say. So I tell my wife, it's money in the bank.
I have a question for you, and it's about these margins. The price of gold is about $2,700 US right now. And has the cost of producing producing an ounce of gold, all the production costs, everything from beginning to end, has it gone up comparatively? Or now can we look at a nice healthy margin?
What happens typically, I'm going to say this, I think gold is catching up. The inflation happened already. So the inflation happened years ago. It's constant. It's always that chase scenario, but this is where gold is where it should have been a long time ago, 2 years ago, I'll say. I think that now that you see it, pressure is going to go on to even higher. Some say 3,000, some say higher. I always look at the rule of 7.2, right? In 7.2 years at 10%, you're going to double your value. So think back 7.2 years at 10%, or think the opposite. Think of 10 years at 7.2% on a kind of okay return. Where should the gold price have been? It should have been doubled in 10 years from 10 years ago, right? We're just getting there. So realistically, everything comes up with it, but the reality is the copper will carry it, the silver will carry it because they outstrip it on the NSR value. So yeah, so when you see it, it's not just a one horse pony. This is a trifecta of three metals. One is an essential metal. One is an essential metal, or rather a industrial metal that's needed. I point to silver as being that because it's used so widely spread in industrial versus precious metal. The essential metal now is copper because of our electrification globally. I think that permitting will be fast tracked because we have such a large, heavy copper component to this.
Any speculation as the cost of producing an ounce at this point?
No. One of the meetings we had this morning was to do an internal scoping of what we're going to do, because do we necessarily need to, how tight do we have to drill off basically all of these supercells? How tight is it required? So we always back engineer things. So what I'm doing is I'm looking at variograms for this style of breccia, because the range is not erratic. You don't have an erratic nugget effect. What you do is you see multiple intercepts with multiple points of visible gold. When you see multiple points of a dusting of BG, of visible, that you see it's free gold, the one aspect of that to me that's curious is the homogeneity. Typically on a gold nuggety effect, you'll have basically wildcat numbers like 1, 200, 300 gram numbers, and then you'll have 1s and 2s, and then you'll have some 3s, 4, 5s. This is very smooth. It's between all the numbers that we hit within the zone are between the 5 gram to the 20 gram range, giving us a 10 gram look. We want to be above the 8 grams because that's the average grade of Brucejack currently producing, with a 6 gram cutoff, right? So that cutoff is probably old and outdated. Now I bet you the cutoff is probably 4.5 grams or even less, because the grade's gone up. Because there is your example where it kicks in, because you've got capex dollars that were spent on $1,800 gold that you went through and spent all that money of developing it. Now this is pure profit. Anybody who's a producer in here has had some of the best years of their lives now and coming forward probably the next 5 years. So these projects will be in high demand now to go get replacement ounces for major companies that are going to be going through their ounces without any kind of, let's call it, political safe havens, the best looking geopolitical arena you can hope for, which Canada falls into that. So we've just had our elections here. It's the same government we got coming back in that basically is pro-mining. They're investing a lot of money into infrastructure in that sector, in the Golden Triangle, on road improvements. They recognize the importance of copper as being one of the essential metals, including the industrialization of things like silver. Gold is obviously, gold will always be gold. I think people in times of inflation that we've seen are now going to be coming back. When inflation drops, people with extra funds will come back into the sector. This is where you'll see liftoff, I think, at this point forward. Easing of interest rates.
I'm looking at your chart right now. We started covering you about 15 weeks ago, and if investors came in back then, a very significant uptick, maybe 30% since then. And today you had a 9% increase in share price. I won't give the date away because this program will air on all sorts of different days, but eyes and ears are definitely pointed toward Tutor right now. Compared to other companies, you've done extremely well.
Yeah, it's taken a while to get the word out. I think de-risking it, a lot of people were waiting for that metallurgical to come out. They're finally digesting it. Patrick Donnelly and Chris Kern just came back from Europe, a swing through some of the European countries. Definitely, I think London was a good one. Zurich, Geneva, all the Monaco even, they touched base there. They're coming back to Paris. They're going to come back to Frankfurt and Munich again. I think just hitting globally the people who've been watching the story, that are sitting on the sidelines and always say, I want to see some economics now. We're going to that. This is where we're going to go with the scoping to see how important it is to get inferred versus indicated on things like supercell. How tight of a pattern does it need to be to get us to what that point is where our engineers are you're comfortable with taking this thing to a full feasibility. Because keep in mind, when you start with these things, you start back of an envelope with an idea or concept. That idea changes all its way through the PEA process up until you have a pre-feas. At pre-feas, you should have had your PEA nailed down fairly well, but a lot of people say a PEA is what it can be. I hate that expression. I hate it because I would rather measure the micrometer up front. We know so much about this. We have so many good data points. I want to make the PEA something that more resembles a pre-feasibility. And that means putting more attention to engineering studies, more attention to the metallurgical circuits, trying to wring every bit of ounce of money you can get out of the material ahead of time so you don't have to do a rethink at the time you're doing pre-feas. That should have happened at your preliminary economic assessment. And a lot of companies make too many assumptions, and I want to avoid that. I don't want some fund manager sitting in London saying, well, gosh, guys, these guys are great looking material, great looking stuff, but too many assumptions, too many de-risk assumptions that should have been answered ahead of time. And this is what we're going to check off. So our engineering firm is very cognizant of this. This is their bread and butter. This is what they do for a living. So we're going to take it through the stage of what they believe is required. It's strong advice that I tend not to ignore, because one of the best basic conferences I ever attended was one where I took up a Garth Kirkham, our 43-101 writer. He basically came out and stated that most PEAs only have about 2% engineering component to them. That's why most fail. He says if you spend more time on that PEA version that you check off, the likelihood of passing on a pre-feas grows up exponentially. And I agree with that. I simply agree with that viewpoint.
I'm a media guy. I'm not a geologist, nor am I an engineer, but I've been on enough site tours to know that the mining engineers are the most important part of putting together a successful company, letting you know if it's economic or not. And if they say no, it's no go. If they say yes, they have to continue to say yes. And it's super important.
They're conservative. You're right. They are conservative. One of the things that we're not overly promotional, we're just not that kind of a group. And I think now that's promoting the numbers. The project should speak for itself. That's the one thing I've always maintained. The data speaks for itself. Look at the numbers, compare it to Red Chris, compare it to Seabridge, go up to Galore, compare it to that, compare it to Shaft Creek. Go have a look what they're doing at Blackwater with Artemis, compare it and see where we stand. You'll be amazed that our grades are on par with Artemis is taking on the surface, but after Artemis gets down, what's the holding grade that carries the mine forward? You look at the grades that we have, they're extremely consistent. That's the other part about it. If grade is king, then consistency must be queen. So we have numbers that are absolutely identical, 200 meters apart on drill holes. It is really, like I say, a geological marvel. It is what it needs to be each and every time. So if you need the higher grades, all you had to do is increase your cutoff. Remember the Odyssey? We started this thing with a 0.3 cutoff on the overall mine concept as being a big super pit. 0.3, we're at 0.75 cutoff now. We've gone way up. We've trimmed off a lot of fat. We've added a lot of ounces. So we've gone full circle by taking this thing from a big super pit deposit of a 0.3 cutoff to basically take it to an underground deposit with a 0.75 cutoff for the majority of the material. Those ounces are still there. We've never gotten into a big, low-grade, low-ball race with anybody. We wanted to get the biggest internal rate of return and make it the richest deposit you have going forward, the shiniest ounces up front. This is the quest now, is to go at it. Some people will say I'm making a mistake doing that because I'm leaving ounces behind. I'm saying, no, I didn't. They're still there. If ever you were to kill a CapEx and look at a deposit, those ounces can be still carved out at any time. You don't sterilize them. They're still out there. It's just a matter of what the operating expenditures are, the OEX expenditures versus CapEx. The capital initial thing, once that's gone, you paid back your money. You're not paying out that basically loan to value, that ratio, what's your cost for interest money. Once you've killed that, you've now got this basically 10% better look at the economics that this thing can carry forward. That means you can drop grade. You can seriously go after the lower components. And as long as you're paying off all your infrastructure's been paid off, you're just running an operating capital expenditures, and that's what you get to. And that's what happens to these big mines. And you cannot predict what's going to happen in 7 years with the price of metals. You can speculate, right? You can think about it, but let's be honest about it. I don't think anybody here on your listeners will think that gold's going to take the crash anytime soon. I don't think so. I don't think copper's going down anytime soon. I don't think so.
We've gone through that already.
Exactly. We're playing catch up. We're playing catch up with this thing. So now you're seeing all the metals catching up to where they should have been. And now if they can ever lead the way, they typically don't, I'll be honest about it. It's wait until you get depletion of metals, then you see a panic. systemic kind of industry-wide panic where everybody's running around trying to catch all the silver projects because silver's gone to $40 an ounce. If you see copper go up to, pick a number, a big number up there, big X number, you're going to see every bit of copper projects been sought after and try and wring out what it takes to produce copper. But the rough part about that equation is it takes it 10 years to start. From the word go, it takes you 10 years to produce on a big deposit. We've shaved off 5 years of exploration. Deposits still wide open in every category. Haven't closed it off. We don't care to necessarily close off more of the same grade. What we want to do now is find the catalyst of the highest grades we can pull out to get this thing to start. It's the starter, like a fire starter. The catalyst that'll start the mine within the mine. The high grade gold will start this thing off while you build it. A company, smaller companies out there that have market caps of $12 billion to $20 billion can easily take this down now, easily, because they have to worry about maybe spending a fraction of what their corporate value is on taking a shot at building out a $1 billion, 2,000 ton a day producer, and then worry about what they have to do in 5 to 7 years on building out the big mine. So it stages it. So it gives them two things, security and timing, to see if in fact copper is still as strong as it is, gold is still as strong as it is, then they can go ahead and light her up when it's time. So during the ramp up of development, it gives you something to dig into, the high grade. You take that down and off you go to developing the rest when in a timely fashion. The press release that we put out, this is all in a timely manner. So if you just use the numbers of how strong this thing could be, and those were conservative numbers, they weren't inflated. The actual numbers were a lot higher. I just rounded them down just to be on the safe side of these things. So that was a speculative, basically, example for everybody to look at when you compare this deposit compared to other deposits, and you compare what the sale prices should be or the infrastructure required to get them up and running. Our power line, I'm told that the BC Hydro line will be twinned in 10 years. You will have plenty of ample power for everybody. Right now, it's undersold. There's power available because Seabridge didn't start production, neither did Galore. It was built for those two. Still hasn't come up to full capacity. So here's the thing. When you talk to permitting, it's going to be a race to whoever can actually get a serious looking mine permit to go to production first, I think is what's going to happen. I think you're going to see a lot of attention given to big projects by other companies. But now that we have an aspect that smaller companies, the mid-tier producers can easily chomp down on, easily. In the past, prior to Supercell, prior to the beginning of the drilling this year, it was only top 6, top 10 companies in the world could have taken this thing down because of the size of it. It would have been a 2, 3, 4 billion CapEx project. Now you're starting at a quarter of that. So that means your target strategic partner is somewhere that can be a lot more of them. There's a lot more of those guys that are producing 500,000 ounces of gold to 1 million ounces of gold a year versus the guys that are producing in excess of the best producers in the world are well over 1 million ounce producers.
So you can get a partner, no problem. I would imagine that you can afford to hold out for quite a long time before ever considering getting taken out. You've got that luxury, right?
Exactly. Pat Donnelly said it best. He says, we've got a couple of years here where we've got room to move forward, the stuff we can do to de-risk this thing and to have fun along the way and have the market carry the value. I think that the more we de-risk it, the stronger the notoriety of the story. That's the first thing. How many people have heard Tudor Gold? That's the thing. I still come across that. It's still not a well-known project. Somehow there's a disconnect. There's a disconnect in the markets where people don't realize how strong this is. I always get this thing when you talk to a company X as a top 3 producer in the world and you tell them all about it and they look at it and say, what's the catch? It's got to be a catch. I go, no, that's just it. There is no catch. This is being de-risked as we go. The road is minus 13 kilometers of a bill. So instead of doing $15 million, do you spend it on building the road or do you drill off Supercell 1 C and D and get 2-3 million ounces in the core box for your final approach on a pre-feas and feasibility to start this thing off? What do? So clearly you put the numbers on the board that put this thing over beyond a shadow of a doubt for what it's going to be. And that's our number one goal now, is to make sure we think that the supercell is as strong as we believe it is. Let's be honest about it. We've got the upper parts of the 300 horizon that are still some rich areas, are 3 to 4 gram material between 50 to 100 meters. Those intercepts are rich. So you talk about taking another approach, but I do believe that because of all the drill holes we've hit with supercell, we've hit so many, everyone has reported great gold values for a high grade complex that's not related to a porphyry. It's something that's post-mortem to a porphyry. It's a independent, superimposed, late-stage, high-grade target, very much like brucejack. So if we do have a brucejack lake that's lurking, and keep in mind, the only reason we discovered it in flurry of these 7 drills is we completely changed the orientation of drilling. We came back at the deposit instead of drilling with it, splintering down through those supercells. We actually went the other way, where we actually stood way in front of the deposit and drilled back at it. So we came a lot more normal than we would in the past. So our approach, you could say, was designed to hunt high grade in the lower CS600. And we found it serendipitously. My prediction was to find one good supercell target, and we did. We had to rename it Supercell 1C. It was the original one because we found 3 more on the way to going through that. There was 3 more, 1 below it and 2 more above it. And they're well away from the CS600 because as you're coming down through, keep in mind, all the targeting was just to hit CS600. It was just to target CS600. We never stood back far enough away to go for the extensions and to see these things isolated without shoulder grades. So our technical team is going back to the data, looking to see if we can remove shoulder grades of lower grades. We can unveil the 10 gram, 10 meter concept that we've got going forward. So that's the goal. If we can try and get something over 6 gram cutoff, that's going to average 8 grams to 10 grams. If we can get that over a sizable width, and by the way, just for the record, you only need 3 meters width to get a galley through, because you're not here to mine all of this. You're here to mine the richest part of those composites just to get access to drill up the CS600, because all of it's going to fall into the block cave. When it's in the center of it, it's the outer limits of what we want. It's just the small portion of it. The bigger, thicker portion is right through the middle of this thing. So when you drop that as a block cave, it's all coming. So you just need the richest portion to take out the best internal rate of return you could possibly get. And that's the goal. Go for the highest IRR for the project to make this catalyst to go over the top. And that's what we're at for this year. This is what we're going to focus on. Look forward to another update here. We're going to go forward, go strong, put our heads down and come up with a really good plan for 2025 and execute like we've always done. We're stayed financially right now. I think it's a matter of us trying to come up with what would look good forward on the de-risking aspect of it. Yeah, just stay tuned and see how we come up with the next plan for permitting, and it may include underground. We may be going underground with this thing a lot sooner than anybody planned.
I've been speaking with Ken Konkin, the president and CEO of Tudor Gold. Tudor Gold trades on the TSX Venture Exchange as TUD, and in the U.S. on the OTC as TDRRF. The company's website is tudor-gold.com. I'm Ellis Martin, and this is Money Talk Radio.